Good morning. Friday. Last Friday of July? No. 31 days in July. This morning, a little different than yesterday. Bonds are rallying. We're about a basis point better, so let's not get too excited. We are below 470 on 10s. MBS up 2 to 4 ticks. So dead cat bounce. I don't know that this even qualifies as a bounce. By the way, already printed building permits higher than expected, but down month over month. Get some new home sales later and S&P. Give everybody a second here to join. Not a heck of a lot to talk about as we kind of rally into the close of the month insofar as the mortgage industry is concerned. I guess Monday is so-called refi day because we're going to be funding on Friday the 31st. Got to imagine that your refis are locked up. Boy, I sure as heck hope so. If not, you've been offsides and you get a little bit of a bounce perhaps this morning. Time to lock. We'll get more into that here in a second. Overnight, just really more of the same. I mean, to me, this almost feels like Groundhog Day. More inflation data, more bond-friendly inflation data, some other general, bond-friendly economic data. And the only difference tonight or last night over the last few nights is lo and behold, oil slightly better this morning. Both Brent and crude down about 2.5%. Crude back below a 90 handle, albeit 89.97 at the moment. Asia stocks down. Europe mostly up. Onshore indicating up. VIX off a little bit. Insofar as other commodities, most metals are up. Bitcoin down. So why do we have a mini rally this morning? And again, rally is a huge word for what we have here, price of oil. And by the way, I really didn't see anything in the overnight. I'm not certain that this isn't selling fatigue, right? Because I certainly didn't see anything coming out of the Middle East that would give us some pause in terms of how we perceive the trajectory of oil. What I will say is, there was a war power resolution, and so maybe Congress is trying to rally around putting an end to this, trying to force the president's hand. I don't know. I got a text message in a text group this morning just about asking about the state of housing and stuff like that, and more so around sort of interest rates and what if tens breach 5%, which I mean we've got still a long way to go. But, one could sort of potentially extrapolate what happens in the stock market if tens were to get to 5%. And I just don't see this president allowing that. At some point, I think the question really becomes, when do we have more to lose than we have to gain with this going on? And this data, both locally, domestically, and globally, continues to move in the direction of lower rates. But this conflict is the lone holdout, and we have control over it. You can end this thing one way or the other, and I know that I probably said this back in March. So as I said yesterday, I've been wrong about it. But I suspect that sometime in the next 30 days, this thing is going to end one way or the other. And when it does, we can get back to a little bit of normalcy. I would just say, and by no stretch am I a commodities expert or am I an oil expert or anything like that, but I mean, this is a lot of noise for a region that only supplies about 20% of the world's oil. 20% of the world's oil in a world that's, albeit maybe creeping, but moving towards some energy independence. I don't know. Never let a good crisis go to waste, as they say. I think just in general, there are a lot of folks offside about a lot of things as it pertains to the state of the economy and the state of interest rates right now. And so what that leaves for you and I is, how do we trade it? Well, hard to see any real value in the coupon stack at this point. If you were listening to what I said, good morning, Bob. You're locked up for July. You're locked up for the first week or so of August, and you just hold out for the data, which is likely to be weak and maybe knock us in the head. I've never been an advocate of taking on risk, and I've been very, very vocal about that on this call. But purely on a chart basis. Ultimate support on Ginny 5.5s is about a 0.5 point worse than where we are. And we are, say 2 points worse than our best levels this year. So in that lose small, win big, in a matter of speaking, we have more to gain than we have to lose. I mean, let's take a look at this for a second. That's a 5-year chart. We're over here, by the way. Okay. Somewhere over here, I think we felt worse about inflation than we do now. I mean, these levels seem reasonably preposterous given that, right? January 25th of 2023, we were 2 points better than we are now. Were we feeling worse about interest rates and inflation in January of 23? 23. We were 2 points better than we are right now. So, if you're looking for silver linings, there's a silver lining for you. June of 24. Let's just see, CPI June 2024. We printed a 3.3 core in June of 24. 5.5s were at par 6, not quite 100 basis points better than where they are now. So, hard to believe that we're going to stay at these levels, given where the data is. Totally different conversation if the data isn't where it is right now. Totally different conversation. Notwithstanding yesterday's claims number. Let me just see if there's, I had a crazy day yesterday and did not look into this jobless claims number. By the way, fewest since 1969. Where that came from is crazy. So let's just say, application for jobless benefits tumbled to the lowest level in more than 5 decades as layoffs remain historically low despite global economic uncertainty. So, the headline is talking about the state of the economy, as we've been saying. The number of Americans applying for unemployment benefits in the week ending July 18th declined 22,000 to 187. Fewest number since September 6, 1969, well below the 215 forecast. Benefits are considered a proxy for layoffs and are close to a real-time indicator of the health of the job market. The economic crisis caused by energy is not over yet. Carl Weinberg, chief economist of high-frequency trading. Okay, that's who we're quoting nowadays. No disrespect there. But usually it's like somebody from Goldman Sachs is all I'm saying. But the labor market is yet to show any signs of wear and tear. Boy, I don't know if I agree with that, but certainly not yesterday's report. But employers pulled back on hiring in the June report, adding only 57,000. Among the companies that have trimmed the workforce recently, Verizon, UPS, Amazon, Disney, Starbucks, Walmart. Microsoft cut 4,800 jobs, or about 2% of its global workforce, earlier in the month, largely due to Xbox. I guess no one's playing Xbox anymore. 4-week average fell by 7,200. So yeah, I thought that maybe somebody would post something about an explanation. Was there some sort of anomaly? I don't know what it could have been, but definitely weird number and something to keep an eye on. So anyway, that's where we are. I would not. This summer in particular, Fridays have been slow lock days. I guess everybody's going to the beach early. Hard for me to really have a compelling lock effort today. What I would say is I need to see some levels to look at for those of you that kind of look at MBS. Some sort of bounce. If you get to the point where you're 25, 101, 25, 101, 26 on sixes, and which is 6.25 to 6.75 note rate, I think that's lock territory. I think that 101.21 on sixes only looks bad because of where we were. June 22nd, we were at 101.26, by the way. So that's where I came up with 26 just off the top of my head. If I do a 3-month chart on sixes, right, we're not really, we're kind of in the ballpark of where we were. 24, 26, 28 was like a good number. So, I think the most compelling argument for locking a rate today would be 6.25 and above. And 5.5s, I think that on a 1-month chart of 5.5s, I struggle a little bit with finding value there. Those are ones that you may want to float a little bit. But remember, bulls and bears make money, pigs get slaughtered. Thanks for joining. Thanks for watching on replay. I will see you guys Monday. Have a great weekend. Crush it today. See you.